Thank you, Keith, and good evening. Those of you who've had the misfortune to come to these events before and heard me speak, you'll be aware that I like to try and emphasise the linkage between investment returns and pension fund performance and the strength of the pension fund. It's always important to remember that the purpose behind the investment is to ensure that the fund's liabilities, i.e. the pension commitments, can be met. We far too often get too involved in deciding whether it's best to invest in Marks and Spencers or in Next, rather than the big question is, should we be investing at all? And if so, should we be property rather than equities? It's even more important to give those sort of considerations in the present economic environment. We need to make sure we remember the bigger economic picture, because over the last few years, since the financial crisis, they've become increasingly important. The economic and financial landscape of the Western economies has significantly changed since 2007-2008, and has fundamentally altered the way investors think and react. It's always been a struggle to balance the inherent conflict between obtaining a reasonable financial return and exposing yourself to too much risk. That inherent conflict has never been more true than over the last few months and years. When investing a long-term pension fund, two of the most important factors you have to think about are interest rates and income yields. Without a steady stream of income, it's difficult to maintain and meet the pension promise. Moreover, both income and the capital value of the fund's assets need to be protected against inflation. Since 1872, through war and depression, booms and busts, the path of real interest rates in the West, i.e. the difference between inflation and interest, has been between 2.1 and 2.5%. Recently, that touched zero. The long-term inflation rate of the same period is 2.8%. At the moment, that stands close to the average of about 2.7%. This slide shows that UK interest rates have been held at a historically low level of 0.5% for 4 years. The annual rate of inflation, however, is now touching close to 3%. In simple terms, that hurts a pension fund. One of the reasons behind such historically low interest rates is a massive injection of liquidity that central banks have been putting into the financial system in order to bail out the banks and to try and stimulate the economies. Known as quantitative easing, the United States is currently injecting $85 billion per month into the economy. That is a huge amount of money. So much cheap money has depressed interest rates around the globe and severely distorted the world's financial markets. A clear indication of this is a fall in bond yields, i.e. the price of a bond compared to the interest it pays. Now, bonds are traditionally the safest form of investment, and those issued by governments, especially Western governments, are normally seen as the safest of the safe. Now, this slide shows how far those bond yields have fallen. You can see in 1996, 7.5%, 8%. Now, we're below 2%. As though in sympathy, even the yields of bonds issued by companies have also fallen to close to all-time lows. To show how unusual the current situation in real interest rates is, the real interest rate on a number of index-linked bonds issued by governments fell below 1% in June. In other words, investors were paying governments to look after their money. So why is this so important? Well, in simple terms, when the actuary values the liabilities of a pension fund, he does so against bond yields. So if bond yields fall, then the cost of the pension promise rises. At a time of rising inflation and falling income, that can be devastating for a pension fund. Over the last 3-year period since the last actuarial valuation was carried out, although both equity and bond returns have been positive, that means that your fund assets have grown. Indeed, the fund returned about 31% over the period. liability values have actually increased significantly ahead of those returns, dominated and driven by this fall in bond yields. That means that the fund's deficit has risen. Now, in terms of the actuarial valuation process we're currently taking place, that is by far the most significant factor and the one that we're having to address. How did your fund respond to these changes? This slide shows how the fund was invested at the end of March. There's still a sizable allocation to fixed interest or bonds, about 21.5%, and about half of that was in index-linked bonds. Because the yields were so low, we didn't buy any more, but we need to hold some of those to match our liability profile because our pensions are index-linked. What we did buy over the year were emerging market bonds, and we also kept our corporate bond portfolio. As the earlier slide showed, we get a better yield on those types of bonds. So our bonds portfolio is worth roughly 550 million. The bulk of the fund was invested in company shares or equities. 1.1 billion was invested in the UK market and just over 2 billion in overseas markets, where we felt the short-term prospects were better. Of course, you've got to remember when we say it's invested in the UK market, we mean shares listed in London or the UK stock exchanges. And a lot of those profits and earnings come from overseas. Of our overseas exposure, roughly 500 million is invested in Europe, 650 million invested in the United States, 600 million invested in Asia and Japan, and about 300 million invested in emerging markets. Now, clearly, the European markets have had a difficult and volatile time, but it is still the UK's largest trading partner and home to some leading international companies, such as Nestle. American equity markets have reached all-time highs as economic data improved, and there are signs that it is going to be the first economy to leave recession. It is the most flexible economy, and in many ways dominates world trade still. And our overweight position in the US certainly helped us during the period. We've long been keen fans of emerging markets on a long-term demographic argument, but over the short term there have been concerns over China's economy and is slowing down. However, we still believe that the long-term prospects for Asia remain good. Was this strategy successful? Well, over the 12 months, your fund produced an overall return of 13.6%, which is somewhere ahead of its expected benchmark return of 13%. As a consequence, the fund's performance is now in line with its benchmark over both 3 and 10-year periods, and compared to the local authority universe over 10 years, it ranks 10th. Now, earlier, when I was going through the asset classes, I didn't mention the fund's property portfolio, but it had another good year. The fund returned 8.7%, boosted by its farmland holdings, against the benchmark return of 2.5%. I'm pleased to say that for the second year running, we were awarded a prestigious prize by IPD, the independent analysts company. How did that performance translate into the formal accounts? Given the staff reduction programmes followed by the fund's main employers, it's not surprising the contributions to the fund fell over the year. Both employers and employees paid in less. Benefits payable also fell, although the actual pensions payable element rose. There was a sharp increase in company dividends, but that was slightly offset by a fall in net property income, rents after expenses. But it meant that overall investment income rose to over 130 million. The biggest change over the year, however, was the value of the fund investments, and that meant at the end of March, the fund was worth £5.3 billion, which is a year-on-year increase of about 600 million. Now, that's the formal part of the presentation over, because I was told to keep it short and sweet. But it's always become a tradition of these events to have a quiz. This year, most of the questions revolve around the value of money, but there's also one about the problems that actuary faces when valuing the fund. This is a straightforward question. The two most common nicknames for the US dollar are the greenback and the buck. Why the buck? One of those four is the answer to that question. For those of us who struggle to comprehend what earning $1 million a year must be like, please tell me which was the first American to earn $100 million in a year. Now, I have to admit I didn't know who Dina Morella is or was. She still is. She was born in 1925. She's been married 3 times, once to actor Cliff Robertson, and owns RKO Pictures with her present husband. She was also on the board of Lehman Brothers for 18 years. So if those of you who know what happened to Lehman Brothers, I want to take that into account when you put your answer up. Who is the richest athlete in history? Now, it's not easy to compare levels of wealth over time, or across geographies or currencies. So not all these names might be known to you. Some are older than others, and whilst I like to point out that these days large sponsorship deals and advertising contracts go hand in hand with sporting success, I would like to remind you that was not always the case. That, for example, is the reason why Tiger Woods is on this list and not Jack Nicklaus, and why Michael Schumacher is on this list, not Jackie Stewart. Those of us who struggle to understand what $1 million means, let alone what $100 million means, can't really comprehend what $100 trillion means. But, in fact, such a note has been issued by a sovereign nation state as legal tender. Now, if you were the happy owner of a $100 trillion note, $100 trillion, what would you do with it? Well, these are a few suggestions. Which, if of them, if any, do you think is factually true? There's 6 for you to choose from. I look forward to hearing your answers. Now, the problem was, the premise of the previous question, we were talking about US dollars. Well, in fact, I wasn't. I was talking about Zimbabwean dollars. Now, at the height of its inflation crisis in 2009, the Reserve Bank of Zimbabwe issued a $100 trillion note. It's not worth quite the same as the US equivalent. How much is such a note worth now? That is a quiz question. And finally, just to bring us back down to earth, and probably most importantly, we've just touched upon the temporary and transient nature of money and the monetary wealth. Let's get back to reality. Pension funds are long-term vehicles. Even though we report investment returns on a quarterly basis, and we value them actuarially every 3 years, the normal membership lifespan of a fund member is about 40 years. It can be 80 years. So which of these statements is true? This belies the calculations an actuary takes when valuing the fund, and is crucial to our understanding of what the pension promise actually means. As the Chair said, we'll give answers to the questions after we've answered questions from the floor and Gary's presentations. Over to Gary.